Welcome, everyone. Thanks for carving out a little time on this Red Friday. I realized we didn't really wear our red. I guess we'll be getting into that. Let's just clarify, Chiefs Red Friday. We got to be a little specific. So, again, most of you, I think, know me who are on the call, but I'm Matt Gazaway, one of the co-founders of BridgeQuest. And obviously, you just heard from Greg Dillard, one of the other co-founders of BridgeQuest and certified financial planner as well. We're also joined today by J.R. Taylor with Invesco. You can see J.R. And then Nick Kalivas is with us as well from Invesco also. So we'll be hearing from them here in just a few minutes, but really excited to be able to kind of give you a deeper dive on really what we're doing, how we're seeing the investment landscape and the focus that we have right now. So we thought this would be a good time. Obviously, last year was a rough 2022. And have had conversations with most of you in terms of, kind of framing that up, but wanted to briefly go kind of recap what we've done in many of your portfolios, give you a short overview of that, and then that'll kind of lead into, where we are and what we're doing now. So we'll take a look at that. Really thinking through last year, I think there we go. Hopefully you can all see that. Some of the changes that we did this last year, again, Fed raising interest rates, doubling rates, historically fast raising of those created a really challenging environment. Number one is early in the year, we shortened bond durations in anticipation of those increases. That proved to be a positive thing. It helped, I guess, because many bond funds were down significantly. We were able to help a little bit on that. And number two, we reduced tech holdings early in the year. For some of you, that meant we had to trigger some cap gains. It was kind of a difficult conversation, but looking back, going, yeah, that felt like certainly the right move, going to a little bit higher quality dividend paying approach at that point. And then most recently, one of the changes we've done is really repositioning our equity holdings across the board and across many sectors to a focus on quality, really good balance sheets in light of really higher interest rates. And certainly JR and Nick are going to get into that a little bit more for us. But I wanted to kind of let you know that's where we have been and kind of where we're headed. And I guess thinking about that ahead, I want to pitch to JR in just a minute, but I also wanted to address, hey, Invesco is one of many fund companies that we work with. I wanted to just reiterate that our process, as much as we really do like JR and Nick, and they are quality people and professionals, we didn't pick them because of that and who they are. We pick based on process and performance, and that's one of the great things about the advisory accounts and the screening and the process. And I think you'll enjoy hearing from them a little bit deeper. And also wanted to just share some of the resources we have. They're an example of resources that we get to lean on. I think sometimes we get asked, how do you make these decisions? Gosh. And so this is kind of letting you, inside and seeing some of that, an example of just great resources. And with that said, it helps us to go, how is Invesco kind of seeing the environment that we're in now? And that's where I'm going to let JR just kind of take it away and tell us some perspective that Invesco and their team is seeing.
A high-level overview of some of the things that I think certainly shaped what markets did last year and are continuing to shape market movement on a daily basis now, and the stuff that we're thinking about going forward into 2023 as well. And I just had a couple of pieces here, and at the end of this, I'm going to flip it over with a couple questions to my colleague, Nick Kalivas. And Nick is the head of our factor and product strategy research for our ETF group. So he spends a lot of time really digging into, all right, we want this type of company. How do we get it? And I think we'll have a good Q&A with Nick here in a minute. But before we get there, I wanted to share some of those high-level thoughts, and I'm going to use a couple of images from our 2023 investment outlook here to kind of help visualize what we're talking about. And I think for any of us that have read the news, watched news media on TV, or just tried to go to the grocery store to buy a dozen eggs over the past 18 months or so, we know that inflation has sort of been front and center in our face for well over a year now. And sort of the buzzword 2 years ago was, will inflation be transitory, or will it be stickier and stick around for a while? And I guess all of that depends on what your definition of transitory is, but it's certainly been around for longer than a couple of months or a couple of quarters that maybe we were hoping for at the beginning of this whole ordeal. And so if you look at the map of the world here, these are two different measures of inflation in headline and core CPI, but these are measures of inflation that the Federal Reserve, the Treasury, the central banks around the world really pay attention to. And the darker bluish color you get, the higher inflation is. Now, just to sort of set the stage or give some context here, for essentially the entire decade leading up to the pandemic, this entire screen would have been I'm not great with the Crayola box, but call it some color of sort of greenish sea blue or magenta or lighter blue color, right? Fast forward to post-pandemic as we start this year, and almost the entire world has inflation that is north of at least 4%, with most of the world being north of 6%. Just a couple areas that have managed to avoid that, China being one, Japan being a famous developed economy case. But the rest of the world has this high inflation problem that they're dealing with. And much of where the market has traded and where the market has moved over the last 12 months especially has been driven by this. And what the market's really paying attention to, and what's really flipped as a result of this inflation data, is the central banks around the world and what their interest rate policy looks like. So going all the way back to the financial crisis that we experienced in 2007 and 2008, the central bank of the US, the Federal Reserve, dropped interest rates to 0%, dropped them to the floor. And this is a common way for central banks to try to deal with bad economic growth or contraction or recession. This is a way for banks to try to stimulate the economy. If it costs less to borrow money, the thinking is that more people will go out and borrow money to do things like start businesses, like buy houses and properties, spend money on their credit cards, buy cars, all of these things that sort of stimulate economic growth. With 0% interest rates, the theory goes that you're essentially giving away almost free money for people to go do the things that may spur more economic growth. And so if you look at the middle of the screen here, after 2008, that light blue below the zero line, that's the number of central banks around the world that were cutting interest rates, so significantly reducing interest rates. We got to zero in this country, but around the world, central banks were cutting interest rates to try to stimulate economic growth. You saw the same thing happen in 2020 as a result of the pandemic. Remember, we're a long way from that now, it feels like, but almost 3 years ago, the fear was not that inflation would be making prices go higher. The fear was that the entire economy was collapsing. And so central banks tried to combat that by cutting interest rates again, getting back to zero, and making sure that people could borrow and spend money to get the economy jump-started again. A lot of the inflation issues that we have right now are a result of cheap money making people spend at a much quicker rate than maybe we all feared back at the depths of the pandemic in the spring of 2020. And so you fast forward to today, and really starting early last year, you see this massive anomaly on the chart of dark blue above the line, central banks all over the world hiking interest rates very, very quickly. In fact, at the quickest pace we've ever seen in at least the past 100 years in the developed world. And this is directly to combat those inflation numbers that we saw in the previous slide. And so what this results in, and these are charts that get somewhat technical, but basically what the Federal Reserve is trying to do by raising interest rates is they're trying to slow down spending, slow down economic growth, and make sure that prices come into check and don't just continue to spiral higher. And so there's a lot of measures to try to look at to try to figure out, is it working or is it not? But you can see the U.S. Consumer Price Index, the prices of a basket of goods, you see that steep climb starting in early 2021. We have started to see that level off. So higher rates partly can be attributed to this, but you start to see that price increases level off. That's a good sign. Some of the other things on here, the dollar index, as the dollar has continued to march higher, that's sort of leveled off as well. So some of the things that the Federal Reserve is looking at seem to be starting to work, which is a very good thing. And another way to look at that is just these global demand numbers. So manufacturing new orders is on the left. You saw it just absolutely fall off a cliff during the pandemic. Nobody was buying anything because the thought process was consumers were going to hunker down, the economy was shut down, nobody wanted stuff anymore. That shot back up in a big hurry, quicker than after the financial crisis, but those have started to come down meaningfully. The supply chain index has rolled over. Part of the problem early on with inflation was that there was a scarcity of goods because we couldn't get goods from where they were being manufactured to where they were being consumed. There was famously a bunch of stories online, on news sources, on TV, and the Journal about just shipping tankers sitting off the coast of China and then sitting off the coast of LA that were full of goods that people in America wanted to buy, but we just had this massive bottleneck where we couldn't actually get them off the ships and into the inventories of retailers here. So what happens if people want to buy a lot of stuff, but there's not a lot of stuff to buy? Prices go through the roof, right? Everything becomes more expensive. And so a lot of these things that are leading indicators of inflation have leveled off and are starting to come down in a big way. That's a very good thing for a central bank or a U.S. Fed that wants to slow down the pace of increases of rate hikes. And it's probably a very good thing for markets that have been in a big way tied to what the Fed is doing. Is the Fed going to continue to raise rates? Or are they going to pause, for lack of a better term, for a while? So that's a big deal that inflation is rolling over. The last thing I want to cover from a charts perspective is the chart on the left here, because I do think that, we have gone into this massive rate hike period, and rates have climbed from historically low levels pre-pandemic to where the 10-year Treasury is, as of today, somewhere in the neighborhood of 4.4% to borrow money from the government, or for the government to borrow money for 10 years. That's a lot higher than it was at less than 2% a couple of years ago. But from a historical context, it's not crazy. We've been here before. In fact, we were here before, just as recently as the financial crisis, or right before it. And when you look back into the 90s and deeper into the 80s, interest rates are still at relatively low levels across the board. So relative to the last 10 years, is it expensive to borrow money and go out and do things right now? Yes. Relative to the last 30 or 40 years, it's still very cheap to borrow money. But what the market is looking for, and what a lot of the day-to-day swings in the market are dependent upon, is when will that line that continues to march higher for interest rates level off and find a reasonable level and stop its march ever higher. So there's a couple of implications here that we wanted to talk about for higher interest rates. And in our view, the Fed is going to probably by the end of March be done raising interest rates. They're probably going to raise interest rates by 0.25% next week, and they'll probably do it again 4 or 5 weeks later. by 0.25, and then we think they'll be done. But we don't think that they're going to be in any hurry whatsoever to cut interest rates. I think they want to maintain a reasonable level of rates, make sure that money costs something to ensure that inflation keeps moving in the right direction or moving down. You know, they want inflation to be about 2%. We've got a long way to go to get there off of a print of north of 6 right now. They think they've done the work, though, in our view. On the interest rate side, inflation will continue to move lower, and they want to hold it there and let it play out in the economy over time. So one of the implications, and Matt touched on it earlier in the call here, one of the implications of sustainably higher interest rates is that it actually costs companies something to borrow money now. And for a long time, companies could borrow money incredibly cheaply. What happens when you can borrow money for really cheap? You might borrow money that you don't even really need to borrow, but on the balance sheet, it looks great because it doesn't cost you much. So you raise cash, you can borrow money for cheap. You also might invest in projects and expansion that maybe you wouldn't do at 5% borrowing costs, but sure, for 2% borrowing costs, let's take a shot, right? It essentially incentivizes risk taking, and that funnels its way all the way down to individual investors like us as well. You're sitting here saying, well, the bank's offering me 0.01% on my savings account. Maybe instead of just keeping money in savings, I should go out for a 1-year CD at 0.3. Maybe instead of going at a 1-year CD at 0.3, maybe I should buy a bond fund at 0.8. Maybe instead of the 0.8 bond fund, I should go buy stocks. It basically just incentivizes risk taking all throughout the economy and markets. Now that that is no longer the case, we've got to think about what type of companies we want to own. And what that leads us to historically, when you get higher interest rates for longer, or at least a decent average level of interest rates at 3, 4, 5% versus 0, is that you want to own higher quality companies. And so that's one of the changes that Matt and Greg made to portfolios, sort of on the back of all of this idea that rates are going to be higher for longer, and the ability to own companies with high quality balance sheets probably rules the day into the near term or intermediate future. And so once we make that decision, we want to own higher quality companies. The question becomes, how do we do that in an efficient way? And what does that mean to own high quality companies? And so that's where Nick and his team comes in to say, all right, we want to own quality. We want to own the quality factor. So Nick, how do we go about separating quality companies from the rest? What are we using to identify what a quality company is?
Yeah, so it's a great question. And quality can be defined in many different ways. But I think at the end of the day, when you look for quality companies, what you want to see companies that have a high level of profitability. They are using their capital in a very efficient way. They generate a lot of cash earnings, and they use leverage in a very smart way. They tend not to use a lot of debt, but it's not necessarily just they use a small amount of debt, but they use it in a very efficient way. So we're looking from a debt perspective, if credit risk increases or if interest rates increase, the companies are not kind of at the mercy of the interest rate market. They're able to function very smoothly through their kind of internal cash flow, or they don't have to borrow a lot in the marketplace.
Yeah, that's an interesting point, and it's a very direct effect of higher interest rates, right? If you're a lower quality company or you want to invest in some long-term project, and you have a bond that comes due that you were paying 2.5% on, and your option to sort of borrow money today is now 4 or 5%, you've got to make sure that the project you're investing in is pretty solid, because it's costing you twice as much to borrow that money, right? And so to your point, companies that are less reliant on whatever funding costs the market's giving them today and can be more self-sufficient from a cash flow perspective tend to operate better in a higher interest rate environment. That makes sense to me. So what types of companies does that lead us to? What types of parts of the market sectors that we find a lot of these types of companies that would be more high quality? And then on the other side of that coin, what may be a company that we would have considered or that we wanted to look at 3 years ago that's a lower quality company that would get weeded out today?
So it's important to just note that the screening process can change over time in terms of picking up companies. Like a company could be quality today, and a year from now it might drop out because it doesn't meet the criteria. Now, what we have tended to see on a persistent basis is these companies that tend to generate cash. They don't use a lot of leverage. So right now, for example, you're actually seeing big energy names show up as quality companies. Now, that was not the case a couple years ago, but we're seeing that now. We have seen companies like Visa and MasterCard, to just kind of bring it very much at home. They're very transactional. They don't use a lot of debt. They generate high return on equity. So those are examples that are companies that are very persistent. But if we roll back 20 years ago, they would have been much smaller. They would have been more fledgling. We wouldn't have necessarily thought about them as quality. But those are, maybe give you a little industry look at their the last thing maybe I'll say is we've seen a few more technology companies in quality. And the reason is they've grown up. They don't use a lot of debt. They've tended to generate a lot more profitability than 20 years ago. And so we're actually seeing more quality companies show in the technology sector than what we would have seen in the past. Now, on the flip side, what don't we see a lot of in quality companies? Well, companies that use a lot of debt, that's typically, they don't show up. And we typically, as a result of that, do not see a lot of utility companies. Utilities, you think about them as being regulated, so their kind of return on equity can be capped. So historically, you haven't seen a lot out of those companies. Historically, we haven't seen a lot of financial companies. And you might ask, well, why is that? Well, they tend to use a lot of leverage as the nature of their business. They're borrowing in the market, they're raising deposits, and then they're basically lending to customers. So we tend not to see a lot of financials. And likewise, we have not tended to see a lot of REITs. But the bottom line really is this idea that companies that have high leverage, they do not generate a lot of cash earnings, and they have lower return on equity, or they don't use their capital as efficiently to generate profits, they fall into that low quality bucket. And sometimes, we'll even call them more junkier type of stocks, but those would be the characteristics.
Great. I appreciate it. And I know that we're about 4 minutes out. So what I wanted to do is throw it back to you, Matt and Greg, and, happy to take any questions that you have or your clients have. But I'll put it back to you, Matt.
Great. Yeah. Thanks so much, JR and Nick. Really great to get that deeper dive. My 20-second summary is we do think it's a really different environment, and we're not going back to how it's been in the past decade. Is that fair, JR and Nick, from your perspective with our interest rates?
I think that's fair, Nick. If you have any further comments on that, on how the regime might have changed for the long run here?
Yeah, I mean, I'm of the opinion like we're seeing kind of a reversal of globalization trends that we have seen. You're seeing some demographic issues that have changed. You're seeing, you've seen big deficits run by governments. And I think all these things have kind of led to the situation where we're probably going to see higher, inflation than maybe we saw in the past. And we're also going to have a more normalized rate environment compared to what we have had. So I think a lot of the policymakers realize that the negatives of kind of free money, it has some bad ramifications in terms of inflation, risk taking, and so as a result, I would look for more normal conditions. I'm kind of a believer in that camp myself.
Yeah, I think to that point too. The other thing that the last 12 years, call it, or the pre-COVID environment, featured was the Fed would start to raise rates a little bit or, do something to cause monetary policy to tighten, the markets went down 10, 15, 20%. The Fed was rushing in to cut rates back to zero or to loosen conditions. And you saw this really sharp, just lower quality or momentum driven rallies where, all right, the Fed's coming to the rescue again. Stocks go straight back up. And that's where this whole buy the dip type mentality started coming in. When markets go down, we know the Fed's going to save us and they're going to rip straight back up again. We may see more of kind of that slower traditional recovery in stocks because the Fed's not riding to the rescue this time because, as you mentioned, I think they recognize that there were some excesses created and they don't want to go back to that zero interest rate policy.
Yep. Great. Want to allow, again, we are getting very close to our 30 minutes. We're going to go maybe just a couple minutes over. I understand if people need to drop off, but we have a couple of questions. And then also I want to just acknowledge that our Q&A below, there is not a Q&A. And so just a little bit of a tech glitch, but what you can do is really do the raise your hand. If any participants have a burning question you'd like to ask one of us, just do the raise your hand, and then we will unmute you. As Greg mentioned, the videos are not on, but we have the ability to ask that question live if you'd like. Otherwise, we do have the other thing you could do is you could email Greg or I direct, greg@bridgequest.com. If you'd rather go that way, we'll hang on for maybe 5 extra minutes here. And we did have a couple of questions that had from the sign-ins, and I'm going to just talk about those. So feel free, though, to hit raise your hand if you have a question, or shoot an email to greg@bridgequest.com. In the next couple of minutes, we'll try to go there. One of the things that was brought up in a question was, what is it? It seems like good news is bad news and bad news is good news. Okay. You look at, and I will just add before I'll let you guys kind of add that. Yes. So true. I mean, we look at Wall Street Journal today, and we see, okay, it looks like consumer spending is down, worse retail numbers. Hey, the market kind of seems to like that. But just speak into this: good news is bad news is good news for the market.
You want to start, Nick?
Yeah, sure. I think there's a couple things going on. I think one is this idea that if the economy slows and we have some, let's say financial stress, that it will actually quicken the decline in inflation. And the more inflation kind of reaches a terminal point, it will back into the Fed stopping its rate hike cycle. And therefore, money can kind of flow back into the market and we can kind of get beyond this current downturn. I think that's at one level. I think the other level is, I think as a lot of market participants have recency bias. And it goes back to what JR said before, where a lot of times people are just so Fed focused that they think if there's bad news, the Fed stops tightening. And so that's good for the equity market. And one thing I always have to kind of tell people is if you kind of cut through the cloud of what's going on, the real important thing for stocks over time is really earnings. It's less about kind of what the Fed is going to do. It's more about our earnings rising or earnings falling. And likewise, what's more important is probably where is the direction of longer term rates as opposed to shorter term rates in terms of determining the valuation. So I think those are some of the pieces of the puzzle and why you see kind of that good news, bad news dilemma or psychology that's present in the marketplace.
That's great. That's good insight, a little bit maddening, but that is really helpful. I think for us sometimes trying to make sense of headlines and some of the numbers and reactions. So yeah, with that said, we are right up on time. I am gonna throw one last one in because we've also heard this one in a couple of reviews as well, and it's just what's gonna keep. I'll just give you a real zinger. With rising interest rates and the Fed and all these things happening, what's to keep us from going into a really bad recession? This whole recession is kind of murky anyway. Are we in one? Are we not? Mild recession. So I'm just gonna. I don't want to end on a bad note, but just tell us, about the risk. Should we be fearful of that? Because we keep hearing about recession. So that'll be, I think, the last question. And
I'll start on that one, Nick.
Yeah.
That's a good. It's a good one. I think that first of all, from a investment perspective and a portfolio construction perspective, you always have to have your base case and then take care of the tail risks in case something like that happens, right? And so, Matt, you opened with some of the things that you all are doing. And, one of the things that stuck out to me is what you're doing in the fixed income space. And you've got some money market stuff and you've got some shorter term fixed income that if we get into a recession will hold up wonderfully to combat any issues that the stock side may have. But, broadly speaking, and so that's why you put portfolios together, not just with 100% of one thing, but diversify out. But broadly speaking, the idea of going into some deep recession seems to be more of a tail risk type scenario and not a likelihood at the moment for a couple of reasons. Number one, I think, is just that we don't seem to have big excesses in the markets or in financial systems right now that can really break, right? And that's typically when we've had big, deep, prolonged recessions, something has actually broken in the economy or in markets in the past, whether that was in 2007-8, where the housing crisis and eventually the financial system was a mess. Early 2000s, the tech sector and these massive bubbles of valuation caused a longer downturn. In the 70s and 80s, it was inflation that was, double digits for a decade, not for a year, right? So some of these things it doesn't seem like there's these big excesses or bubbles or potential for contagion that typically have led to longer term or deeper recessions. This seems to be more of a situation where spending is going to slowly come down. There may be the jobless rate might tick up a little bit, but those are necessary evils for keeping inflation in check and bringing prices down. Doesn't seem like something that could lead to a real cliff or a real bad recession. Nick, what do you think?
Yeah, I'm gonna just highlight, some of the things I see. I think one, this whole idea of onshoring, bringing the supply chain back home, is really something that is a positive. I think second of all, the government has spent a lot of money, and there's a lot of movement even by private industry for kind of infrastructure building. So, we see things like new semiconductor plants being built in the U.S. We see EVs being built. We see need to upgrade the electrical grid. I mean, if you look at an indicator called the Dodge Momentum Index, which is probably a foreign term, but it's a proxy of commercial construction orders. That index right now is actually at an all-time high, which, we all think about housing being kind of in the dumps because of affordability, and it certainly is struggling. But there's another side of the equation, which is actually kind of positive for growth. And we even saw, steel companies make some comments on that in their earnings, consistent with what we're seeing in that kind of Dodge Momentum Index. And I'd say the last thing to think about, and this sometimes goes a little bit lost, is we really do live in a great time where there's a lot of innovation, there's a lot of technology development, and these things do push growth forward. Now, we can have kind of cyclical declines, But just think of how much we've seen transpire in our lifetimes, and I think that's not really going away. So those are some of the things to think about, I think, in terms of putting it all in perspective.
Yeah, that's great. Really helpful. As we frame where we are and kind of where we're headed. And I just want to close. I don't think I see any other hands at this point, and so I want to honor our time and just very grateful. Thank you, obviously, to JR and Nick for taking the time, and our participants, our clients. Thank you. It's kind of, we can't see you, but we know you're there. And as you know, just, if this stirs up something, a question, just let us know. Give us a shout. You know how to get a hold of us. We're going to continue to try this format, probably on a quarterly basis. We'll have some different topics along the way, but we'll be doing another one, a webinar in the second quarter. And we hope that it's something that is helpful and zeroing in, and certainly want your input, positive, negative, or at any level. So we really, really value being able to manage and steward your resources, and we just want you to kind of get a small glimpse of a deeper how we're thinking and the kinds of resources and the kinds of geeks that Greg and I are. We hope this has helped you get a little deeper feel and picture of that. And with that said, I'm going to go ahead and sign off, say go Chiefs, and we will talk soon. Thanks.